Confused about whether to invest in index funds or individual stocks? You're not alone. In this video, we'll break down the pros and cons of each to help you decide which strategy aligns best with your financial goals. Section 1. Understanding index funds and individual stocks. Index funds. These are funds designed to replicate the performance of a specific market index, offering broad market exposure. Individual stocks. Investing directly in shares of specific companies, allowing for tailored portfolio construction. Section 2. Pros and cons of index funds. Pros. Diversification. Provides exposure to a broad range of stocks, reducing the impact of any single company's performance. Lower fees. Typically have lower fees due to passive management. Reduced risk. Lower volatility compared to individual stocks. Cons. Limited control. Investors cannot select specific companies within the fund. Average returns. Aims to match, not beat, market performance. Section 3. Pros and cons of individual stocks. Pros. Potential for higher returns. Successful stock selection can lead to significant gains. Control. Full authority over portfolio composition. Targeted investments. Ability to invest in specific companies or sectors of interest. Cons. Higher risk. Increased volatility and company-specific risks. Time-consuming. Requires extensive research and active management. Lack of diversification. Concentration in a few stocks can amplify losses. Section 4. Which should you choose? Consider index funds if you prefer a passive investment approach with broad market exposure. You're seeking lower fees and reduced risk. Consider individual stocks if you have the time and expertise to research companies. You're aiming for potentially higher returns and are comfortable with higher risk. Both investment strategies have their merits. Align your choice with your financial goals, risk tolerance, and the time you can dedicate to managing your investments. If you found this video helpful, like and subscribe for more investment insights.